Stocks don't just triple overnight. Investing in stocks isn't child's play. It takes quite a lot of research to find the right place to invest in. If you're a beginner, we suggest you watch this before you invest in the stock market in 2021. Research on the stocks you're investing in. If you don't know much about how the stock market works, you're at risk of losing quite a lot of money. Not only should you do in-depth research into the general stock market, but also the stocks you're interested in buying. What does the company you're investing in manufacture? Do they provide any services? Is it reliable? How is the company's image in the market? You can't just blindly invest in any company. You need to make sure you have enough knowledge about the company and the products or services it sells. But how does one find information about different companies, you ask? Well, it's quite simple. You can always take a look at the company's official website and its official social media account. You should get most of the basic information in the About Us section. If you want a bit more in-depth information, you can always check online forums. If you're curious about something and can't find any answers online, you can always contact the company service center. You'd be surprised to know how willing companies are to answer customers. Price to earning, PE ratio. If this is your first time hearing the term, don't worry. The concept is pretty simple to understand, even for newbie investors. The price-to-earning ratio refers to the company's current share price to its per-share earnings ratio. The PE ratio helps the analysts and investors determine the value of a company's shares. Think of it this way. Say you want to compare two companies. One company clearly displays the amount of profit people have gotten from investing in it over the years. They also give you a clear ratio of how much they get from each dollar you invest. For instance, if you invest $1, the company keeps 30 cents and you get the remaining 70 cents. In contrast, there's another company that's newer to the market and doesn't have much history to represent you with. However, you do get more percentage of your investment. For instance, if you invest $1, you can keep 85 cents, while the company only keeps 15 cents. Although you don't know for certain if you can make much profit, if any. The first option may seem a bit expensive, but it's better in the long term if the company is growing faster. Plus, it's the safer option compared to the company you know little to nothing about. You can calculate the PE ratio of various companies and compare the values while you do your research. If a company has a high PE ratio, there should be a logical reason behind the high ratio. If you see a company with a low PE ratio, but the ratio has been growing quickly over time, then maybe you might want to think about investing here. Beta value and volatility. Want to know how volatile a company's stocks are? You can simply use beta to assess the systematic risk of any portfolio in comparison to the rest of the market. The beta basically shows how the stock prices have been behaving in the last 5 years. When you run a Google search online, you'll be able to find the company's beta value on the same page as the PE ratio. S&P 500 should be considered as the measure for stability. If it drops or rises above this, then it has a higher beta. A higher beta than 1 means higher risk. On the other hand, a beta lower than 1 means lower risk. However, keep in mind that if a stock has a lower beta, then it won't react to the S&P 500 movement. In addition, you need to know that there are mainly two types of funds. The first, referred to as the equity-oriented funds, have a variety of equity holdings with only a small amount of debt. These are usually funds with high volatility. On the other hand, you have debt-oriented funds. These are mostly made of debt instruments and have only a small portion for equity. These have a lower volatility rate. The safety of dividend. Another super important thing to look into is the dividend, especially if you can't monitor your stocks regularly. Dividends work in a manner similar to how interest works in savings accounts. Regardless of whether the stock price is high or not, you will receive a payoff. Dividends are usually distributed by the company to the shareholders in the form of cash. Some commons do share dividends in the form of stock shares as well. The amount is usually decided by the board of directors. The reason why dividends are so important is that they provide investors with a steady source of earning. Some companies usually give out dividends on a quarterly basis. Regardless of the prices on the stock market, the dividends provide some security to the investors. It's best to invest in the companies that have a high value for dividends. Charts, and more charts. Bar charts, line charts, candlestick charts. You'll see all sorts of charts when you start researching the stock market. It may seem daunting, but charts are super important if you want to understand the rising and falling stock market values. Even if you don't intend on becoming a pro investor, learning how to read all of these charts is super important. If you know the basics of reading a chart, you'll know that if the graph starts at the bottom left corner and is growing steadily towards the right, it's an increasing trend. This means investing in some stocks might prove beneficial. In contrast, if the graph keeps dropping as it moves toward the right, it's better to steer clear. Of course, not all charts are as simple, but you'll only be thanking us later on if you start learning how to read the different stock charts. Not only can you read past and present trends, but you also might be able to predict future trends. Liquidity of your stocks. Liquidity means how quickly your stock investment can be converted into cash. You can liquefy your investment when you sell it or once it reaches maturity. When looking into the liquidity of any investment, there are a few things you need to take into consideration. The first factor to take into account is the lock-in period for your investment. The lock-in period refers to the time period when you can't liquefy your investment. It won't be any use investing in a stock that's stuck in a lock-in period for half the year now, would it? Another thing to take into account is all the costs that come along with the liquefaction of an investment. Let's take a closer look at some of these costs. Brokerage. This refers to the fee that you have to pay brokers for facilitating transactions. This fee can vary from broker to broker. However, if you do a little research, you'll be able to find a reliable broker with discounts on the brokerage. If you're lucky, you may be able to get brokerage for as low as 0.1% to 0.25%. Security Transaction Tax, STT. The Security Transaction Tax, or STT for short, is a tax charged for the sale and purchase of all stocks listed on the stock exchanges. Generally, STT should cost you around 0.1% of the transaction value for shared transactions. On the other hand, for mutual funds, STT should cost you around 0.001% of the transaction price. Redemption charges. This is important to look out for, especially if you have a mutual fund. Every time you try to sell or redeem the mutual fund, you may be charged an additional fee. This fee is usually a percentage of the sale amount and can range from 0.25% to 1% of the redemption prices. Any other hidden charges? As with buying or selling most items in the market, there may be some hidden charges for the liquidation of your stocks. This may include a difference in buying and selling price, which usually occurs in mutual funds if there's a difference between the net asset level and the redemption price. For those unaware, net asset refers to the per unit price of a mutual fund. Other factors. Other things that you may need to consider include market depth, which will tell you whether any purchasers are looking to buy the asset that you're selling. If you plan on investing in a company that's located outside your country, you need to ensure that you're following all the regulations set by the foreign exchange management. You may be charged additional fees or taxes for international investments and transactions. Investing in stock and hitting big isn't as easy as the media makes it seem. However, with these guidelines and a little more research on the latest stock market trends, you'll be able to get a better idea of how to invest your money wisely. Keep in mind that stock market trends, along with the company's history, are both super important to look into before deciding to put all your money into a stock. How has your research on the stock market been so far? Let us know about your experiences in the comments below.